Hey there, everyone. Today on the Final Bar, happy Monday. The S&P 500 confirms a new swing high, or does it? Bit of a rollover going into the close, finishing slightly below Friday's strong finish. The 10-year yield stable as we await tomorrow's CPI number for October, and we'll have a live Q&A. Get your questions in now in our live chat. Ladies and gentlemen, this is the Final Bar. Hey everyone, welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Good to be back with you live here. We took a couple days off, headed down to College Station, Texas, visit the Aggies, do some support of the CMT Association, help to spread the word of technical analysis, encourage people to understand the lessons the market provide back to us. I had a lot of great conversations with some of the professors, the students there, and others in the community there in the technical analysis community in Texas. And again, it was a great reinforcement of a lot of the concepts that we talk about on the show, just the idea of looking at price action, what price really represents, right? The interplay between buyers and sellers, between the emotional states of fear and greed. There was a lot of discussion about sentiment, about fund flows, about how we measure how stocks are moving and why they're really moving, and why it's most important to just focus on the message of the markets. As we look at the markets today, Friday, an exceptionally strong close, right? A nice way to finish the week in a position of strength. A lot of stocks like some of the Magnificent Seven, semiconductors, the QQQ sort of breaking out of that downtrend channel. The S&P pushing above 4,400, and the question was, do we get a follow-through day on Monday? I would say no, right? If you look, the S&P finished slightly below where we were on Friday. Now, what you have to remember, this is kind of an expected holding pattern type of day. Big CPI number coming tomorrow. That's the main gauge of inflation that most would refer to, including Fed governors. So what happens tomorrow could tell us a lot about the trajectory of the markets for the next 6 weeks or so, taking us through the holiday season into the beginning of 2024. Hard to believe that's coming up that quickly. With that in mind, let's get to a brief market recap. As a reminder, the live chat is open now. After we do our market recap, we will be going to the chat, so start getting your questions in now. While you're finding that chat and putting in some great questions we can address here on the show, we asked you recently in a poll question, which sector do you think performs better over the next 3 months? Now, I've asked this question a number of times recently, and that's on purpose. We want to kind of see where people are at and see what sort of optimism and or pessimism we can tease out based on the responses in the poll. The XLY, consumer discretionary, getting 56% of the vote. Consumer staples, 44%. So a little more offense over defense. Now, as a reminder, why do we ask that question? Why do we phrase it in that particular way? Well, this comes from one of the more traditional measures of offense versus defense, something that I found in my Fidelity days, which was, looking at things you want versus things you need. When conditions are good, when the economy is growing, when consumers are kind of optimistic and happy, they have money available because the interest rate environment is more hospitable. They're able to spend money on discretionary purchases, things like travel and tourism, hotels, new clothes, new cars, all of those sorts of things. When things are rough, when the economy is slowing down, when interest rates are more high, when inflation is elevated, when you don't have a lot of excess money to spend, you still have to buy alcohol. Well, you don't have to, but most people do. Alcohol, tobacco, household goods, cleaning products, personal products, beverages in general, those sorts of things. And so, this is a general measure of things you want versus things you need. What's interesting is if you look at the ratio of the XLY to the XLP, that's this top series. The bottom is the equal-weighted version of that, the RSPD and the RSPS. Those are two equal-weighted ETFs for consumer discretionary, consumer staples. Look how flat these ratios have been really since the end of June, right? You go to the end of the second quarter, go to where we're at here in the middle of the fourth quarter, these ratios are basically flat. So what that tells you is with all of the rotation, the move into the market high in July and August, the pullback in September and October, this rally we've had from mid-October to mid-November, all of that, taking into consideration, offense and defense are still kind of in line. And I think that tells you a lot about the conditions. As much as you may be tempted to be super bullish and super bearish, and I promise you, if that's your goal, I can come up with reasons why you could be those things. But that's a little too confirmation biasy for my taste. But if you think about it, a lot of times the market's just sort of a sideways. It's sort of an unknown or an unchanged. And I would say that's what these ratios are telling you. No clear signal, no dominance of offense over defense. I would say one of the ways to use this chart is to be super bullish or bearish when that ratio breaks one way or the other. It looked like we had a bit of a breakdown there in late October, but for now that breakdown repelled and we're back in the middle of the range here. Let's go back to sort of the market recap, sort of the high level, see what happened today. I mentioned, I'd sort of had it all ready to tell you, all right, the S&P confirms a new swing high because it looked like we might be getting some momentum here in the afternoon. But by the end of the day, the last 30 minutes, a little weaker. And really most of the day was spent kind of in that unchanged, really within, a couple points of Friday's close. And again, that's expected because tomorrow we have October CPI coming out before the open. That's a big number because I would argue one of the, arguably the chart to look at besides the S&P would be interest rates, 10-year yield, and thinking about what higher or lower rates mean for consumer behavior, for growth stocks, for a lot of other things. And so tomorrow's reading may be an influential one, certainly if there's a shock one way or the other. So reasonable to expect the S&P to be sort of choppy sideways, and that is indeed what we got. The S&P finished down slightly, 0.1% lower. The Nasdaq Composite down by 0.2%. So that keeps the S&P just above 4410, still above that 4400 level, which we really focused on at the end of last week. The Nasdaq 100, sort of the largest names within the Nasdaq, down about 1/3%. You can see the VIX actually popping higher just a little bit. It was down almost to a 13 handle on Friday, pushing back up a little bit off of the 14 level, so around 14.8 for the VIX. So still pretty low volatility based on historical standards. Interest rates really ended the day not much of a change. If you look at what happened today, though, the bond prices actually opened up kind of lower. Interest rates opened up higher, but through the course of the day, bonds actually rallied going into the afternoon session. So the TLT only down about 0.2%. 10-year yield essentially the same as where we were on Friday. That's around 463. So again, I would argue with tomorrow's CPI number, that's where you could have a more of a movement in a lot of these assets that we've just talked about. Dollar just slightly below yesterday's close. Commodities all in the green here. The DBC up about 1.5%. Crude oil prices up about 1.6%. Natural gas, this using the UNG, was up over 6%. Gold and silver both up about 0.5% as well. Finally, cryptocurrencies. At the end of the day, chopping around quite a bit. You can see Bitcoin around 36,700. Chopped around quite a bit during the weekend. Got above 37,000, kind of back below, but that's sort of that range we've been looking at since the big break above 31,000. Got up to that 35 to 37,000 range, kind of hovering there. So down 1% from yesterday over the weekend. Ethereum prices up about 1.5%. You can see the rest basically mixed from the other most liquid coins that we track. Looking at the sector returns, kind of a value over growth, I guess, sort of feel to the tape. If you think about the three sort of general buckets, kind of cyclical, value leadership, growth leadership, and then pure defensive plays, it was sort of in that order. So you have value like energy and healthcare at the top. You have some of the growthy sectors like technology, communication services in the middle, and then the really defensive stuff like utilities at the bottom. So your top three sectors today, the XLE energy leading the way higher, up 0.7%. Now, a lot of these stocks looked very vulnerable last week. Oil prices coming off, of course, in the last couple weeks, pushing energy prices down, bouncing up a little bit, seeing some divergences potentially to pay attention to. We'll try to get to some of those if we have time. Healthcare, number two, up 0.6%, followed by consumer discretionary and staples, pretty much even, about 0.4% higher. On the downside, real estate and utilities, your two worst performing sectors, followed by technology, which was actually down 0.6% today. Let's go to a daily chart of the S&P 500. That's the one. As I'm looking at the week last week, sort of that big move the week prior, you can see last week's sessions mostly within this little range around 4340 up to around 4400. Now, Friday was the big move. Friday opened strong and just traded higher through the course of the day. Just this nice upside follow through. And as you've probably heard from a lot of the discussions we've had, I've been more on the cautious, let's wait until the market proves itself. Depending on what chart you're looking at, I would say last week was a pretty good validation, particularly the QQQ, clearly breaking out of that downtrend channel. And I have to assume that is the move of the least resistance, right, is moving higher. The S&P closed above trendline resistance, closed above the October high. I think that's all pretty constructive. The only thing I would be waiting for is some sort of follow through. So you have to have a big move through resistance. It's all about that next day. Do you get sort of additional validation? We did trade slightly higher than Friday's close. We actually closed down a little bit. So I don't know if this was that follow-through day you may have been looking for. If you're all bulled up and just waiting for that last check, I don't know if you got that. But overall, is this is the path of least resistance higher or lower? I would argue probably higher at this point, given the fact that we've broken out. You're waiting for that last confirmation, but overall, I would say with a lot of the major names to follow, those magnificent 7 stocks, as we'll see here in a minute, pretty constructive. Now, 2 other charts to show you from my Mindful Investor Live chart list. I was actually writing a note for my market misbehavior premium members over the weekend. And one of the things I wanted to just highlight quickly was the difference between the new Dow theory, which is using the S&P 500 and the Nasdaq Composite, with last week's rally, and really today was sort of this slight downtick you see on the end of the chart, but last week was really following through above the October high. So both the S&P 500 and the Nasdaq, this is the Nasdaq Composite actually, sorry, on the bottom, $COMPQ on StockCharts. Both of these on a closing basis eclipsed their October highs. Done, check, thumbs up. I think that's fine. Look at the same chart using the equal weighted versions of those 2 indexes, and you can see they have not broken out. So think about that for a second. The cap weighted version, dominated by the mega cap stocks, breaking out on both charts. Look at the equal weighted version, which basically takes the mega cap overweight out of the picture and is more about the other stocks and what they're doing. Neither of these have actually confirmed. Now, that's the one that I like to follow because it sort of, again, takes that magnificent 7 overweight out, and it more looks at those the breadth, and more looks at the breadth of the individual stocks. These have not broken out yet. So, I mean, one other thing that I would love to see is a more of an improvement in the advanced decline data, which would tell you that there's more strength, and also breakout from the equal weighted versions of those charts. That would happen, and I could come up with reasons to be bearish, but I think they'd be very, very few and far between. I think the bullish evidence has been mounting. I think last Friday's close was pretty significant. We'll see what happens tomorrow. Again, I think holding our breath for the announcement tomorrow. Just to finish off here, I just want to highlight some of the names here. Of course, there's a lot of earnings this week. It's a little more retail-y, so it's names like Gap and Ross Stores, TJ Maxx later this week, a bunch of other sort of a consumer type of week, and some other random names as well to pay attention to. But just a couple names to highlight today. Boeing may have been the biggest gainer in the S&P. I believe it was. It was up 4% today. And what's interesting about the chart of Boeing is with today's gap higher, 4%, look at what happened. It actually took us above $200 a share. Now, 200 was key, number one, because it's a big round number. Number 2, look at this shooting star candle that you have second week in October, which was the last time we were below 200 and traded up there. Sort of validated that as a resistance level. We've traded up to that point over the last 2 weeks, but have held below it. Today's gap actually pushes above that resistance. I think that's important. Now, we've traded right up to the 200-day moving average. That's, I would argue, your next level of resistance, right around 208. But the momentum is now strong. It's in the bullish range with the RSI pushing above 60. We've made higher highs and higher lows. I think this is a chart in an uptrend. Look at this bullish divergence on Boeing. Lower lows in October, higher lows in momentum. We're going to look at a couple other charts here briefly. Just as a reminder, in a few moments, we're going to go to the live chat and finish the rest of the show just taking questions from the live chat. So if you have a question, put it in now. We'll get to as many as we can. Those we don't get to, by the way, we'll put in the Final Bar mailbag, and we'll get to hopefully later this week. Now, think about that move higher in Boeing, right? That gap higher, impressive, higher highs, higher lows. Now, contrast that with the 2 charts I'm about to show you. This is gold miners. Different setup, right? This is more of an inverted head and shoulders kind of pattern, maybe a complex version of that, where you have the low surrounded by some higher lows. But the resistance is right around $30 a share, and we are holding that. Last week, actually drifting lower, and look at this gap lower, and then we continue to drift lower through the course of this week. The 200-day moving average right around 30. So I think the GDX, gold miners above $30 a share, pretty constructive, but we are not above there. We're actually well below there. Another example of that would be like a Home Depot, right? Think of, again, that chart of Boeing gapping higher above resistance. That's what you're not seeing on a chart like Home Depot, right? We're given the opportunity to break above previous resistance, break above the 200-day, not happening. So that's why, from a technical perspective, I would argue it's important to have those levels, that line in the sand, something like the GDX, that resistance around 30, something like Home Depot, resistance around 300. It pays to be patient. It pays to wait for that breakout, which validates that buyers are coming in, that demand is outweighing supply. We're not seeing that follow through on some of those charts. So given the opportunity, this is where I think charts can be so helpful to help you compare and contrast different stocks or ETFs. I would argue focus on the ones where you are seeing that sign of accumulation. You're seeing buyers coming in. you're seeing higher highs and higher lows. Some of these charts are doing that, other ones are not, and I would focus on the ones that are showing that upside follow through. That's our market recap here for today on a Monday afternoon. We're going to get to our live Q&A here in a few moments. Before we do it, just a couple quick announcements. First off, we love hearing from you. We have the live chat going on all of our live shows, so anytime you see that open, pop a question there. We'll sweep all of those as much as we can and get to as many as we can on a live show. But anything we don't get to, we'll put in our Final Bar mailbag. You can also email us your questions at thefinalbar@stockcharts.com. On X, just tag us in a comment at FinalBarSCTV. Also, did you know we have another YouTube channel? We have some really cool documentary-style content focused on the StockCharts platform, some really interesting things to stretch your thinking and give you some better tools and capabilities with which to try to make sense of these markets. On our YouTube channel, assuming this is where you're watching it, go up to the page where it says channels, click on that, and you'll see the other one's just called StockCharts. A video I point you to is one of our producers created a video called The Panic of 1907. This is from over 120 some or so years ago, but so relevant to today. A lot of the issues, a lot of the challenges, a lot of the financial considerations that made the Panic of 1907 what it was are echoed hundreds of years later here, 100 years later, when you think about the financial crisis. Think about questions of financial stability. It was happening then. Markets rhyme. Markets have sort of this consistent pattern because humans are humans and we make bad decisions and we get nervous and we get excited. So check out that video. Really great historical perspective and hopefully make some of the more current financial crises a little more relevant. So make sure you go to our other YouTube channel, subscribe to that one as well, and you won't miss the next cool video that we put out. Let us get to our live Q&A again. Thanks so much, as always, for making this interactive show. We'll get to as many questions as we can. Let's get to question number one. Here we go. $ WTIC or USO. These are crude oil, crude oil futures and the crude oil ETF made an inclined head and shoulders. In this case, how do you target potential levels? Brilliant question. Let's get to it. So here on my intermarket analysis chart list, I have both of those. We'll start with the USO. And again, I get a lot of questions about which one should you use. Honestly, I think of them interchangeably, to be honest with you. What happens is if you look at a longer period of time, you really want to use the spot price or the futures price because that's really a better way to track the actual market. Something like ETFs a lot of times can trade at a premium or a discount, and particularly on a commodities ETF, you have a rollover effect because they have to roll over and there's a cost associated with that. So over time, something like the USO will become disconnected to the returns of the underlying, the crude oil. And that happens with most commodity ETFs, especially futures-related ones, just because of the way that they have to create it. So over a longer period of time, I would use that. For the short term, I would argue they're probably interchangeable. I won't worry too much about that. So let's see. You were saying an inclined head and shoulder. So I think what you're referring to, I'm going to come up with a nice blank chart. What I think you're talking about would be sort of this period right here, and saying that this is an inclined head and shoulders. So let me do this here. Here, how do we start over? We'll do this. There we go. And then I'm going to annotate kind of what I think you're going for, which is, all right, parabola. We've got the head here. We've got a right shoulder. We've got a left shoulder, and that means the neckline is right there. Yeah, so, in general, is this an inclined head and shoulders? Yeah, and what that means is a head and shoulders, a head with a left shoulder and a right shoulder, and it's an incline because it's all sloping higher. The neckline is sloping higher. Would I feel better about a traditional head and shoulders where the neckline is more flat and the left and right shoulders are even? Yes, and I would say that is the more idealized pattern. But in reality, it's not always like that, and this is what you're seeing here. So the measurement technique is actually the same. And here's how you would do it. So with any sort of pattern like this, and I'll make this red just so we can see it, you take the head, the top of the head, down to the neckline. And I'm using a log scale chart. It's about a 13.5% range. You basically say, there's the breakdown. What's the downside objective? Puts you a downside objective around 65. With any of these kind of topping patterns, the general approach is you take the height of the pattern and you subtract it from the breakdown. Or on a bottoming pattern, you take the height of the pattern and you add it to the breakout level. So that's kind of what you're seeing here. That, again, assuming that that's the breakdown, that would put a downside objective around 65. What's interesting here is what I love about this sort of analysis, these sort of patterns, they don't happen in a vacuum. So on the way down to that downside objective, which again is kind of down in this range, you also have had this bounce off of the 200-day moving average. So there are other levels that make sense. So as always, look at where we're at, what we call the final bar. Look to the left. Make sure you have a sense of where we're at right now. So at this point, we're trapped between the neckline, which usually serves as resistance, and the 200-day, which is clearly support. We break down through the 200-day. I would say that measures to around 65 for the USO, and you do the same measurement for the crude oil spot price, $WTIC. You'll get a similar sort of projection level. The levels might be look a little different, but that is how you'd measure it. Next question, EWZ. Keeping it simple. This is the Brazil ETF. Let's bring this up. I guess your question is, what's up with EWZ? Fair question. An interesting kind of a commodities theme so far to the questions. So the problem I have with the chart of Brazil is it just really hasn't done particularly well. Essentially, if you look, especially if you look at a couple of years, right? Look at a weekly chart of the Brazil ETF. It might make sense to look at an unadjusted version of this. And I mean, this is where Brazil has been. I mean, it's been kind of choppy, sloppy, sideways in the middle for years now. So what you've had these swings, a lot of times tied to commodity price, really crude oil prices. But at the end of the day, we're sort of in this no man's land, kind of chopping around sideways. Now, in the short term, you've certainly seen some potential strength here. We're testing resistance, and if you go back to September, we rallied up to around 3250, 3270, we'll call it. Had this really good set of candle patterns. That's a shooting star candle there, and then the gap lower, really suggesting that's a potential resistance level. In the last week, we traded up to there. So the general way I would approach this on a short-term time frame is we've now reached resistance. Do we follow through? And if we do, I would suggest there's no real levels left until a retest of these significant highs. That's the high from April of 22. Here's the high from July. It's right around $34 a share. So general way of thinking it in my book is you break above 32.50. That opens the door to 34. That's your upside objective, at which point you reevaluate it. Overall, I think you have to wait. I think if you've missed this move, I think you have to wait for this breakout to see if that's validated and go to the upside. But again, as a medium-term, longer-term investor, really longer-term, what concerns me about Brazil is just other things have done quite much better. Others have done quite worse. Brazil's kind of just sitting in there in the middle, and have you really gained much from owning Brazil over the last couple of years? Certainly not, compared to what you could have done in other places. So it's more the opportunity cost of Brazil than the technical perspective. Great question. Do you see a bullish? It's commodity day. It's oil day. Okay, this is great. Do you see a bullish divergence on the daily chart for Brent futures? And do you have an ETF that you'd recommend for it? Great question. ETF, I don't have one. I don't really, and to be totally clear, the Brent crude oil is really thought of as more of a European oil benchmark. I tend to look at the U.S. oil benchmarks, and again, it's just simplicity. If I was a commodities guy, I'd probably look, and people that I know that are more commodities oriented like to look at that relationship between the two and a lot of other stuff to try to make sense of the oil markets. I tend to keep it a little more higher level with oil prices. So I just look at $ WTIC and the USO. Those are the two things that I look at in particular. Brent crude, though, I mean, if you look at this, you were mentioning the bullish divergence, and I think what you're talking about is this right here, which I would not agree that that's a great divergence. What you're referring to, if you're saying a bullish divergence would be this right here. Bullish divergence would be lower lows in price, higher lows in momentum. I'm not really getting that. I mean, I think at best that's flat, if not even slightly lower a little bit. So that's kind of a tough one. So I don't know if I would describe that as a bullish divergence. If you're thinking price is going lower but momentum is not, it's not really a great divergence. And I have people, I know people that would describe it that way. I'm a little more of a purist with that. For me, a momentum divergence means price is going down and the indicator is sloping higher. That's a clear divergence. I don't think you're getting that here. So I would say I'm less bullish on the chart because of that. And I would see this more as we've broken to a new swing low. We're below the 200-day moving average. Nothing good happens below the 200-day, as I feel like I've mentioned many times on the show. So get back above the 200-day. I think it's something to think about, but I would personally be waiting to get that validation. I saw your follow-up question, by the way, Kenneth, talking about EWZ. Fair point on the 8% dividend. That's why I actually did the underscore EWZ, because with such a high dividend, it usually is better to kind of take the dividend weight out of the price performance, especially if you're looking at a longer period of time and you're analyzing price levels, because it can paint a sort of a skewed story of the actual price action. So the dividend, the argument for it, that I could see. The price action, the capital appreciation, kind of a thumbs down for the reasons that we talked about. Great question and good point on the dividend. That's a fair point. Next question. What do you think about uranium? There was a uranium ETF I was actually talking with. This has come up a couple times here recently. And of course, uranium has done quite well. There's the one, URA was the one I was looking for. So the uranium ETF, uranium stocks, incredibly strong. Katie Stockton, when I talked with her last, I don't know if we actually talked about uranium on the show. We might have, but I know we talked offline about uranium stocks. We were talking about just areas of the market that are showing strength. And it's like when, sort of August, September, when it feels like everything's rolling over, what's actually working? And it's okay, some technology, some of the, mega cap names, of course, like a Microsoft, doing well at times. Insurance stocks within the financial sector, sort of thinking of those buckets. And uranium is one of those areas that have done quite well. I think this is a strong chart, and it seems to be getting stronger. I mean, in early October, it felt like this was pulling back from a significant rally, significant resistance. Now, all of a sudden, it's pulling back to an ascending 50-day moving average. That's what I would describe as a fat pitch chart. We're sort of, going through the baseball playoffs now, wrapping that up. And a fat pitch, if you're not familiar, it's a pitch right over the plate. Like, doesn't matter what the count is, what the game situation. It's just like a great setup. You might as well take a swing because high probability it's going to have a good result for you. A fat pitch from a technical perspective, the way I would think of it is a long-term uptrend, right? A strong chart that's weak in the short term and pulling back to an ascending 50-day moving average. Great way to think about it. RSI pulling back to just above 40 is often a good way to think of it. That combination of the two, really powerful things. So I think in mid-October, really nice setup. And now it's following through. Look at these pullbacks to the 50-day popping irons. I think URA is one of the charts I think looks pretty strong here. And again, just think about what's interesting is look at how different this chart looks than the average stock you would bring up or the average ETF you'd bring up in November of 2023. I think that's what's most compelling about a chart like uranium. So I think still quite a good thumbs up for the uranium ETF and some of the names as well we won't get into, but I think pretty strong as well. All right, next question. What are the chances that Tesla fills in the gap above at 242.08? Given the recent inverse head and shoulders, would filling the gap be more likely? Great question. I was actually looking at Tesla earlier today, just thinking about what the market is. So you were saying an inverse head and shoulders. Interesting. So I think what you're looking at, let's go to a bit of a shorter term chart. It's like a 1-year chart. I think when you're saying an inverted head and shoulders, you're talking about this right here. So my first comment would be that is too short of a time frame, in my opinion, for an inverse head and shoulders. Head and shoulders pattern, if you go back to like the Edwards and McGee book, again, antiquated now. I mean, it was written in the 50s and 60s when their work was, that they based that book on. But really, that is the Bible of pattern analysis for sure. Really the note of record for price patterns and how to measure them and how to validate them. They talk about a head and shoulders pattern being like a longer term pattern, a multiple month kind of pattern. Same with like a cup and handle pattern. You may see those kind of looks on a shorter term time frame, but it's really more intended to be a larger structural pattern. So I would not feel super comfortable calling this a head and shoulders bottoming pattern. Now, others, my peers in the industry, may disagree with that, and hey, that's why we have a market. we don't all, as much as you may think, we actually don't agree on certain things. I found that just from reconnecting with some of my colleagues and peers in Texas last week. We did not agree. I did not agree with everything that was presented, but I agree with the importance of thinking about price action. We just have different ways of doing it, right? And you find that with the guests on the show, right? You have some different perspectives sometimes. But what I would agree with is we've made a higher low, and I think that is something to know, right? And that goes back to kind of Charles Dow 101. Are we going down or are we going up? This higher low, I think, is pretty meaningful. And what that tells me is as long as we hold that higher low around like 205, we'll call it, good chart, certainly in the short term. Now, over the longer term, I'd much rather us fill this gap and get back above the 50-day. That would take us back above this resistance. So inverse head and shoulders, that's not what would tell me that this is more likely to go higher. The fact that we've put in a higher low tells me in the short term, this chart is innocent until proven guilty. And so higher lows, higher highs are good. Make a higher high, close that gap, get above 230. That would be the trigger. If you're short-term oriented, that would be the trigger I'd be looking for to sort of validate that breakout, because that's the lower end of the gap around 230. That's where we failed about a week and a half ago. Let's get above there, and all of a sudden this chart looks a little more constructive. So that's how I would sort of think about it at the moment. And then again, if you do go higher, there's your resistance, right? The upper end of the gap, and also 241. That's right where the 50-day moving average. So that's your upside potential for now. You get above there, and I think that's a pretty strong chart, but still more to be proven from Tesla. Next question. Hi, David. As S&P 500 moves above the downtrend channel, how can we measure the breadth of a breakout? Interesting question. Let's take a look. Yeah, so I tell you what, if it's okay, let's start with the QQQ, because I think that's a clearer channel. The S&P is not as clear of a channel, it was a little different. But if you look at the QQQ, I would argue more of a kind of plain vanilla, kind of basic downtrend channel. And this is what I mean, right? Look, these are parallel lines. And what I mean is on stock charts, you draw one line, you hold down the command key, or I think the control key on a PC keyboard, you click on the first line, it'll create a parallel trend line. That's a great way to draw a perfect channel. And what's interesting to me is when they line up and the slope of those lines are the same, I think that just further validates that this is indeed a channel of lower highs and lower lows. What are you waiting for? A break out of the channel. It's literally wait and see. Let's wait for the breakout. So the QQQ getting above 370 last week, breaking out of that channel, I would say pretty bullish. So I would argue we've broken out, we've had the follow through, and this is a strong chart. And I would assume that this is in a bullish phase until proven otherwise. And for me, we'd have to get back down here and break below like a 340 and get below the 200-day, get below Fibonacci support. We hold above there. This is a pretty good chart, I would say, on that medium-term time frame for now. So how do you measure height? So there are ways that I've seen people do it, like measuring the height of this and kind of projecting it up. I'm not as much of a fan of that, particularly for something like this. I think that's kind of twisting it. With certain patterns, particularly reversal patterns, you take the height of the pattern and you project it. So that's why like an inverse head and shoulders, a consolidation, like a coil pattern, some sort of like a basing pattern, a rectangle on the chart, you can take the height of the pattern and project it out. For something like this, it's really more about the trend leading into the pattern. And if you really want to have your mind blown, what this actually suggests, if you call this a bull flag, which I think you can make the argument, here's the flagpole, here's the flag, and when you break out, which we've now done, that suggests a parallel move to this one. So from the low in late December to here, you project that from the breakout. There's your upside potential off the monitor to the right of an expectation going into 2024. That's kind of the general way you would use that pattern to measure it. For me, I'm usually in this sort of environment paying more attention to looking to the left and looking for key resistance. So I think at this point in the short term, that July high is pretty important. So getting above 390 would be key, and then it's all-time highs that we're keying it back to. So those are the ways you can measure using a pattern. This is actually a continuation pattern, basically assuming. That's why that breakout is so important. It's actually a pretty bullish breakout here. Next question, do you think the calendar effect is valid here where markets decline this week? Titus Ryder, thanks for the question. Yeah, so you're talking a little bit more about the shorter term pattern. And again, tons of respect for Jeff Hirsch, the Stock Traders Almanac, his father, Yale Hirsch. I mean, foundational work on seasonality, which I find very helpful. And, if you're debating the value of seasonality, look at what the seasonal trends would suggest for 2022 and 2023. Overlay that on the actual market environment. It's really close. And I remember having Jeff Hirsch on this show last fall before the October low, and he kind of laid out, look, this is what probably happens. You have a major low in October, you rally into year end. The first half of a pre-election year is very strong, and then you usually have a pullback in the third, fourth quarter, and then you have a rally. It's like literally followed almost exactly what we talked about. It's remarkable how often that actually plays out. And that's why I always focus on those seasonal trends, because fighting those, I think, are often not a great thing. It's interesting in the short term. We had Tom Boley on the show recently when he was in town in Redmond, and he talked about that weakness traditionally in the end of October. That played out pretty well, and now we've rallied very nicely in the beginning of November. I'm a little less of a purist on particular weeks and like number, right? October 20th tends to be a down day. That's a part of kind of that seasonality. I think for me, it's a little too granular. I would much rather focus on bigger picture things. That's why we tend to talk about on this show things like October or November or January or June. It's more about the month and what tends to happen as opposed to particular days. So I'm less keyed into seasonality telling me the next week is going to be a little rough. I am more keen on the traditional strength in the fourth quarter, particularly November and December, which tend to be very strong. So we could sell off into December. That would be highly unusual. It has happened. Look back at 2018, but for me, I think it would be highly unusual. And again, just the way that seasonality has played out. Look at the average strong and weak months. Look at what's actually played out since last year. It's been pretty effective. So I'm inclined to assume that that's going to continue to be effective. November and December tend to be pretty strong. Great questions, you guys. As always, I really appreciate the thoughtful questions, taking us a number of different places. If we didn't get your question, don't worry. We'll put it in the mailbag, and we'll try to make as much time as we can on future shows to get some of the questions in the mailbags. We've had some really good ones recently. But we've got to wrap the show, folks. We're out of time. Let's go to the 3 in 3. 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. Looking at the S&P 500 and the breakout above resistance. And again, I don't know if we had a resounding follow-through day. I remember in my note to my premium members on market misbehavior over the weekend, we talked about how important the beginning of this week is because of that follow-through. I don't think you necessarily got that today. We certainly didn't break down at all. But I think this more than anything is a wait-and-see mode. I think the follow-through will likely either come tomorrow or it doesn't, right? Tomorrow you have the CPI number. Either inflation is a huge issue and the Fed needs to leave the door open to future rate hikes, or at least pushing down the road the idea of pulling back on rates, or we get some inflation number that tells us, all right, things are great, inflation coming down. All the stuff that the Fed has done, all the reassurance we've had from Fed governors is well-founded, and the market goes is much stronger there because rate hikes, all of a sudden the calendar is stepped up a little bit. But what I'm concerned on this first chart is the discrepancy between the cap-weighted S&P and the equal-weighted S&P. Any equal-weighted measure of pretty much anything right now is a lot weaker than the cap-weighted version. Now, that's not the end of the world. You can go back here in the last 5 years and find plenty of times where mega caps have led and small caps have not. But again, over the years, over longer cycles, you really want, if this is a pure risk-on environment, if this really is a bullish phase where things are going up, then you need a better participation from equal-weighted measures of strength. You need better performance from breadth indicators, which are not particularly strong. It's still less than half of S&P members above their 200-day moving average, even today, after last week's strength on Friday. And these sorts of charts need to break out. So if I'm you, I'm setting an alert for the RSP, which is the equal-weighted S&P ETF. Look for an alert when it breaks above 143. There's your thumbs up. It's not just the mega caps, but some of the other things are working as well. Chart number 2, Chevron. If we look at the chart of Chevron, this is a perfect example really of a number of divergences. If you look to the left here, I've highlighted some of these divergences. I just quickly before the show was just trying to pick out some of them to show them. A bullish divergence, of course, is where you have lower lows in price, higher lows in momentum. Ideally, the first low is oversold. The second low is not. June, July of last year, great example of that, right at the 200-day moving average. That was pretty good. At a market peak, a bearish divergence would be higher highs in price, lower peaks in momentum. We're overbought, and then we're not. And you can see that often is the end of a bullish phase. Look at this bearish divergence we had, which was beautifully timed here in September. Higher highs in price, weaker momentum. We now have the opposite. We have a bullish momentum divergence working for Chevron, some of the other energy stocks. Lower lows from late October to mid-November, higher lows in momentum. That continues. That's suggesting maybe a bottoming of sorts and a potential short-term rally on energy stocks. The third chart in the 3 and 3 is the opposite. We actually have a bearish momentum divergence. Nike today. Now, I'm thinking of other companies. Nike is not reporting earnings there at the end of December, but you have a lot of other retailers coming out. So I was looking at some of the consumer discretionary names. This week you have earnings from like Gap and Ross Stores, which is a potential cup and handle pattern, which has yet to be validated. TJ Maxx, some of the other retailers, clothing retailers are coming out. Nike really trading up to the 200-day moving average. When you have a bearish momentum divergence going into the 200-day, that is not a bullish development. You can see we've, for now, traded below there. I think Nike's a compelling chart if it gets above that resistance around 110, 112, but it hasn't done it yet. And the bearish momentum divergence tells me the breakout unlikely until conditions start to evolve. Folks, that's a wrap for the show. Thanks so much for joining us here on a Monday afternoon for the Final Bar. As always, we appreciate your questions and thank you for supporting us and StockCharts TV. By the way, best way to support us right now, hit like, hit subscribe. Join us for the next episode tomorrow. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night, and a shout out to my friends in College Station, Texas. Thanks so much for your hospitality. Giga Maggies, whoop!